All right, welcome back to another explainer. Today, we're doing something really exciting. We are putting a true medical titan through a totally rigorous, data-driven financial gauntlet. We're looking at GE HealthCare, a company that is essentially standing at the crossroads of massive AI innovation and, well, some deeply concerning balance sheet realities. So let's just dive right into this gauntlet. $15.1 billion. Just let that number sink in for a second. That is the staggering amount of blown goodwill currently sitting on GE HealthCare's balance sheet. Driven largely by their recent massive acquisitions, especially that $2.29 billion buyout of Intelerad, this single number really sets the stage for our entire explainer today. We're looking at a company with just incredible scale and world-changing medical technology, sure, but hiding right beneath the surface is a literal mountain of intangible risk. If any of that goodwill becomes impaired, the impact could be absolutely devastating. But before we run this stock through the gauntlet, we have to establish our ground floor, the base reality. Right now, GE HealthCare is trading at $73.69 per share. That gives the business a market cap of over $33 billion and an enterprise value of $41.75 billion once you factor in their debt and cash. So this is our baseline. This is the exact price tag the market has assigned it today. So is that $73 price tag a bargain or a trap? Let's find out in Section 1, the Valuation Gauntlet, where we'll synthesize 21 distinct valuation models to find the stock's true intrinsic value. Okay, so what's really interesting here is the stark contrast between our first two groups of models. In Group A, our discounted cash flow models are incredibly optimistic. Because of projected 6 to 8% growth, which is largely driven by this massive AI-led innovation cycle and global imaging demand, these DCF models cluster really high. They're suggesting a value anywhere from $80 to $115 a share. But then you look at Group B. The dividend and income models predictably drag the average way, way down. GE HealthCare pays out a token 14-cent annual dividend. Because of that tiny payout, standard dividend models output unrealistically conservative valuations, with some going as low as $3.50 a share. Moving right along to Group C, let's see how this builds out. When you line GEHC up against medtech peers like Siemens and Philips, the multiples actually say this stock should be trading between $90 and $125. It trades at a sizable discount to the sector right now. However, Group D brings us back to earth really fast. If you look at asset-based models, including a honestly terrifying fire sale liquidation value, it prices out at just $15 to $25 a share. That's simply because this is an intangible, heavy medtech business. The physical replacement cost just doesn't capture the company's true value. And finally, Group E factors in real options. Think of the upside of new AI product launches, and that pushes valuations back up toward the $95 to $130 range. So, what does this all mean? The absolutely crucial takeaway is this. When we blend all 21 of these rigorous financial models together, the average intrinsic value lands in a range between $75 and $105 per share. Remember our base reality. The stock is sitting at $73.69. Mathematically speaking, the stock currently appears fairly valued to maybe slightly undervalued. But as we know, math doesn't tell the whole story. That brings us to Section 2, the media blackout, red flags versus green flags. We have to start with the deep red flags, and man, there are some big ones. Beyond that $15.1 billion in goodwill we talked about earlier, the single biggest concern right now is liquidity. Their cash literally collapsed by 53% in just 6 months, totally drained by acquisitions and buybacks. Now, the media likes to frame this as strategic deployment, but when you pair that massive cash drain with total borrowing surging past $10 billion, it's a huge liquidity drawdown. Add in the severe integration risks of paying a massive premium for Intelerad, unresolved headwinds in China forcing management to be super cautious, modest free cash flow conversion at about 79%, and a recent cut to their EPS guidance, you basically have a powder keg of underlying pressure. But hey, don't count them out just yet. There are some incredibly powerful, overlooked green flags. From a purely valuation standpoint, the stock trades at a major discount to its medtech peers. An analyst price target suggests roughly 12% upside to $82.50. Operationally, they boast a stellar 19.38% return on equity, and they are actively expanding their operating margins. But the real rocket fuel here? It's growth. Their high-margin pharmaceutical diagnostics segment is accelerating, up 15.6% year over year. Combine that with an AI-led innovation cycle that literally just drove order intake to record highs, securing massive revenue visibility, and you have exactly the kinds of catalysts that could trigger a massive run. And this brilliantly illustrates the ultimate tug-of-war happening with this stock right now. On one side, you've got the bear case, a company struggling to digest a risky, cash-draining acquisition, burdened by a heavily leveraged balance sheet and macro headwinds in China. But on the other side, the bull case, a wide-moat AI innovator with surging, record-breaking orders, high returns on equity, and a deeply discounted valuation compared to its peers. It's a true clash of narratives. To try and break this tie, we're stepping into Section 3, the Legends Reality Check, where we run GE HealthCare through the investment frameworks of 3 legendary market titans. First up, the absolute father of value investing, Ben Graham. Would he buy it? Honestly, no way. It's a hard fail. Graham's strict formula outputs a value of just $48.70. GEHC has a tangible book value of just $24.30. For a strict Graham disciple who hates intangibles, paying almost $74 is an absolute non-starter. Okay, what about Peter Lynch, the champion of growth at a reasonable price? Another hard fail. Lynch loved the PEG ratio, price to earnings divided by growth. He always wanted to peg under 1. GE Healthcare's trailing PE is almost 17, but its growth rate is only around 6 to 8%. That gives it a PEG ratio of roughly 2.4. For Lynch, the PE is simply way too high for the growth it's actually delivering. So let's see what the Oracle of Omaha, Warren Buffett, would do. This one is a bit of a mixed bag, but ultimately, it's a pass for Buffett too. Now, he would absolutely love the owner's earnings yield. It sits at a very attractive 8%, especially compared to Treasury yields. And as we mentioned, the return on equity easily passes his 15% requirement, clocking in at over 19%. He'd also really appreciate the company's wide moat. But here is the massive deal breaker: return on invested capital. GE Healthcare's ROIC is only about 8.84%. That completely fails Buffett's strict 15% minimum threshold. The business just isn't generating the high returns on capital that Buffett demands from his investments. It all goes back to Buffett's famous rule: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Now, our models tell us the price is fair, maybe even wonderful. But looking at that low return on invested capital, we have to ask ourselves a tough question. Is GE Healthcare truly a wonderful company, or does its heavy debt load and inability to efficiently generate returns on its capital make it just a fair one? All right, let's wrap this all up in Section 4, Moat and Final Verdict. Look, despite all those balance sheet concerns we just talked about, make absolutely no mistake, GE Healthcare possesses a massive, expanding, wide moat. This moat is built on 3 solid pillars. First, intangibles. They have decades of imaging technology leadership, heavily protected IP in pharmaceutical diagnostics, and new AI platforms that competitors simply cannot easily replicate. Second, switching costs. Once a hospital installs and integrates multi-million-dollar imaging equipment, they do not just swap it out. It is incredibly sticky. And third, efficient scale. With an installed base of over 4 million imaging systems globally, they have a massive recurring maintenance revenue stream. This moat is world-class, and for sure, it's widening. So here is the final verdict from our gauntlet. Taking literally everything into account, the 21 valuation models, the deep red flags of debt and goodwill, and the incredible green flags of AI innovation and wide moats, the blended fair value for GE Healthcare lands at roughly $85 to $90 per share. At today's price, it is a world-class franchise trading at a modest 10 to 20% discount. But, and this is a massive but, that discount exists for a very good reason. It is heavily weighed down by a risky debt-fueled balance sheet and a company that is still trying to digest a really massive acquisition. The numbers might be screaming buy, but that balance sheet is whispering wait. So I gotta ask you, which side are you on? Is GE Healthcare a classic wide moat at a fair price that you should absolutely buy right now before this AI-led innovation cycle really takes off? Or is this just a leveraged value trap where the debt and acquisitions are ultimately going to crush the returns? Drop your conclusions in the comments below, hit that like button if you found this breakdown helpful, and subscribe for more deep dive explainers. Remember, always do your own homework. Thanks for watching, and I'll catch you in the next one.